Here's the brutal truth most traders never confront. A winning trade proves itself early. Not instantly, but early. And that gap between instantly and early is where amateurs lose months of progress. Jesse Livermore had a simple test. A test so sharp it cut through fake conviction and emotional attachment. And he called it quietly and privately the 2/3 time limit. If a trade didn't show partial confirmation within a certain window, usually 2/3 of the expected move, it was living on borrowed time. Professionals obey that clock. Amateurs pretend it isn't ticking. This video is about that clock, the silent metronome that determines whether a trade has true momentum or whether it is simply drifting toward disappointment. But before we unpack the rule, let me show you the problem. Most traders think time is neutral. Livermore knew time was deadly. He believed the longer a trade needed to work, the more likely it had already failed in principle, even if not yet in price. That belief shaped every decision he made, from position size to stop-loss placement to pyramiding strategy. To him, time was the confirmation that amateurs forget to measure. Imagine those two traders standing at the same pivotal point where a breakout forms, and picture the professional sizing small and waiting for the tape to offer that first thrust. The clean early push that tells him the market agrees with his thesis. The amateur enters the exact same setup but in a larger size, gives it a loose stop, and mutters that the stock just needs more time. And that simple rationalization becomes the start of a slow emotional spiral. Hours turn into days, days into rationalization, and rationalization becomes a trap that locks his attention onto a position that is not paying for that attention. This is the hidden tax of slow trades. They demand constant emotional babysitting. Both traders had the same entry, but only one demanded early confirmation. That difference in expectancy creates the difference in outcomes. The professional is free to move on. The amateur is chained to a position he now fears leaving. Time becomes his captor, not his guide. This idea that time is a risk, variable shocks most new traders, because they've been trained to think only in terms of price. But Livermore treated time as the second dimension of confirmation, the silent judge that reveals whether a position has real sponsorship or whether it is nothing more than a slow bleeding distraction. A slow trade forces you to babysit it, analyze it, justify it, and reinterpret it each day, and every extra hour spent inside that fog of uncertainty weakens your clarity and dulls your process. Professionals don't tolerate this drain. They know that the longer a trade drifts sideways, the more their conviction decays, and the more likely they are to miss the true leaders that are breaking out cleanly. Time either sharpens a trade or corrodes it. Livermore used the 2/3 time limit to detect corrosion early and to avoid emotional erosion before it rewired his psychology. Livermore frequently warned traders that the market punishes emotional attachment far more than bad entries, and he believed that most damage comes not from violent reversals, but from slow, stagnant action that drains conviction. He understood that patience is a virtue only when applied intentionally, not when used as a shield for hope. And the 2/3 time limit helped him separate intentional waiting from emotional waiting. A winning trade doesn't need to explode instantly, but it must reveal intent, and that intent is felt in the early phase of the move. The tape becomes decisive, the volume supports the action, and the pivots begin to hold. Without these signs, the trade is merely drifting, and drifting trades rarely become big winners. Livermore avoided drift like he avoided debt. It erodes without announcing itself. It lures without offering progress. And once it takes your attention, it steals your opportunity to act on stronger signals forming elsewhere. The deeper message behind the rule is that slow trades carry hidden opportunity costs, because every moment of stagnation distracts you from stocks that are actually making decisive moves. Livermore believed that attention was a trader's most precious capital, and he guarded it fiercely, refusing to let a dead or sluggish position consume the mental bandwidth required to notice real leaders rising out of clean bases or decisive breakouts. While amateurs obsess over the trade they already placed, professionals focus on the trade that is proving itself right now. This contrast defines the professional identity. He respects momentum because momentum respects him. He does not negotiate with lagging trades because he understands they are already signaling weakness through their lack of early follow-through. Time reveals strength just as surely as price does. But amateurs ignore that revelation. Livermore's maxim, "A man must know when to hold, when to fold, and when to wait," becomes impossible to apply without a framework. And time provides that framework by offering a neutral measurement that cuts through emotion. What counted as confirmation wasn't guesswork for him. It was progress, measured against expectation, and that expectation created accountability. When a trade moved as it should, he rewarded it with attention and capital. When a trade lagged, he cut it without negotiation because he refused to let hope replace evidence. This discipline separated him from the crowd. Amateurs hope their trades will work. Professionals test whether their trades deserve to work, and time is the test most traders fail to administer. The 2/3 time limit was Livermore's tool for administering that test precisely. The professional identity is built on this inversion, the willingness to judge trades not by the comfort they offer but by the speed with which they reveal their character. Amateurs confuse movement with meaning, but professionals read the sequence, rhythm, and tempo of price action, because the market's strongest moves rarely hesitate in their early phases. The 2/3 time limit became Livermore's internal metronome, reminding him that the market's best opportunities don't drag their feet, and that a trade that needs time to get going usually ends up consuming more time than it ever returns in profit. Professionals know that a slow start often leads to a slow end, and they refuse to get trapped inside positions that cannot prove themselves without delays and excuses. This chapter also seeds the mystery that runs through the entire lesson. How did Livermore actually measure progress? What counted as partial confirmation? Was it a fixed time frame, a percentage move, or a structural shift in the tape? The truth is more nuanced than a rigid formula, because Livermore adapted the rule to the nature of the stock, the quality of the setup, and the context of the broader trend. But the underlying principle remained glued to his methodology. Time must validate the thesis, and if time fails to do so, the thesis must be discarded. This principle gave him clarity in markets full of noise. It prevented him from falling in love with lagging ideas or overstaying his welcome in trades that had already signaled their weakness through hesitation. The stakes are enormous, because slow trades don't just risk capital, they risk discipline. And once discipline erodes, the trader begins compounding mistakes that ripple across the entire account. A slow trade forces a trader into an emotional holding pattern, and in that pattern, he becomes reactive rather than proactive, watching the market for signs that validate his hope instead of signals that refine his process. Livermore avoided that trap by enforcing the 2/3 time limit, knowing that every long-lasting stagnation created mental bias, and every mental bias bent judgment away from the truth the tape was already offering. The longer a trader stays in a lagging position, the more he feels obligated to stay, and that obligation becomes the chain that binds him to mediocrity. By the time many traders realize a position has stalled, they have already lost clarity, and the market has already moved on to setups that will generate the very moves they wish their stagnant position would produce. This is why Livermore insisted that the market decides quickly, and if it does not decide, the verdict is already in. He believed that a trader must align with momentum, not negotiate with it, and that alignment begins with early confirmation rather than late justification. The longer a trade needs to develop, the less likely it is to offer the clean trend that professionals depend on. Patience is not a license for passivity. It is a strategic choice that must be applied only when the trade has already earned it through early progress. As this chapter closes, the puzzle pieces begin to align. Professionals treat time as a risk variable. They judge confirmation by pace, and they eliminate slow trades long before those trades inflict financial damage. This lays the groundwork for the next chapter, which explores why the early move matters more than the entry itself, and why Livermore believed time filters truth far more effectively than price. Most traders think price is the signal, but Livermore knew time was the filter. and understanding that filter changes how you evaluate every setup that crosses your screen. That distinction between signal and filter separates professionals from amateurs more than any indicator or chart pattern ever could, because amateurs watch candles while professionals watch behavior, and behavior expresses itself through time. When a stock hesitates, churns, or drifts during the phase where it should be building pressure, the professional raises an eyebrow and begins questioning the premise, not out of fear, but out of respect for the market's rhythm. Livermore often said that weak trades whisper their weakness through hesitation, long before they shout it through breakdown, and the 2/3 time limit allowed him to hear those whispers early. The amateur, by contrast, responds only to the breakdown itself, and by the time it comes, the damage extends far beyond the chart. It spreads into confidence, routine, and judgment. This is where the 2/3 time limit reveals its power, because it creates a structured expectation rather than an emotional reaction. Livermore treated each trade as a hypothesis, and every hypothesis needed evidence, not just movement. If the evidence failed to appear within the allotted window, he did not take it personally. He simply acknowledged that the market had not confirmed the thesis and moved on to better opportunities. This ability to withdraw attention quickly allowed him to stay aligned with strength while others clung to weakness. It is no exaggeration to say that the discipline to exit lagging trades early contributed more to his legendary runs than any single entry signal he ever used. What most traders misunderstand is that the 2/3 time limit was not about speed for the sake of speed. It was about integrity of movement. A market that intends to trend shows intent early, even if the move is modest, because the underlying sponsorship expresses itself through decisive price behavior. Livermore watched for that intent, the way a seasoned sailor watches the wind, not by looking at the waves, but by feeling the pressure that precedes them. When the early thrust appeared, he added to winning positions with confidence. When the thrust failed to appear, he stepped aside without regret. This relationship with time gave him a psychological advantage, as significant as any technical one, because it reduced hesitation, doubt, and paralysis. As we reach the final turn of this opening chapter, all the essential themes lock into place. The market rewards decisiveness, punishes hesitation, and reveals its true character through the interplay of price and time. Livermore built his method on this interplay because it allowed him to differentiate real momentum from false starts long before the average trader recognized the difference. The 2/3 time limit sits at the center of that philosophy, acting as both strategy and safeguard, ensuring that no position remained in his book without proving its merit. This rule prepared him for the next move, the next leader, and the next trend, while amateurs remained anchored to positions that whispered nothing but uncertainty. By grounding his judgment in time as much as in price, Livermore ensured that every position had to earn its place in his book, and in the next chapter we explore exactly why early confirmation holds such decisive predictive power in the structure of winning trades. Livermore's obsession with early confirmation wasn't a preference. It was a survival mechanism born from watching thousands of trades decay, simply because the trader gave them the one thing a weak setup feeds on: time. He saw time as a magnifying glass, the kind that exposes the true nature of a trade rather than flattering it. If a position was sound, the tape would reveal intent early. If it was weak, the same tape would reveal hesitation, ambiguity, or outright contradiction. But to understand why this principle mattered so much, you have to step inside Livermore's head during his formative years, back when he wasn't a market wizard but a kid counting small fluctuations with a notebook, learning which moves mattered and which were noise. He learned that real moves behave with purpose. They don't wander into their trend. They attack it. The first thrust is the purest moment in any trend's life cycle, because it's the moment when the stock telegraphs its intention, before the crowd arrives, before the news rationalizes it, before the lagging indicators confirm it. That thrust is the market whispering, "I'm going." And Livermore believed that if you didn't hear that whisper early, you weren't trading the move, you were trading your hopes. He used to demonstrate this by pointing to a chart where a stock broke out, then drifted sideways in a sleepy drift. Novice traders love these drifts. They look safe, They look controlled. They look like it's just consolidating. But Livermore viewed them with pure suspicion. He'd say, if it truly wanted to go, it would already be going. Why do you think it's resting when it hasn't even run yet? To him, a stock had the right to rest only after proving itself, not before. Yet young traders inverted that logic, assuming silence was safety, sideways action was commitment, and lack of movement was winding up energy. Livermore knew better. He had seen too many traders pile in because a stock was taking its time, as if time was a supportive structure rather than a corrosive acid, dissolving their edge. He taught that time without movement was the market's way of saying, nothing special is happening here. Move along. The anecdote of the young trader who added to a drifting breakout was not just a warning, it was a window into Livermore's worldview. The young trader didn't add because of signal. He added because of boredom. That distinction mattered to Livermore more than anything else. Because boredom is the emotional cousin of forcing trades, and forcing trades is the fast lane to ruin. He believed that no trade deserved additional capital, simply because the trader wanted something to happen. Wanting is human. Moving is market. When Livermore asked him, "What has it done to deserve more of your money?" It wasn't sarcasm, it was doctrine. The silence that followed wasn't embarrassment. It was truth exposed. The stock had done nothing. It had earned nothing. It had shown nothing. And so, it owed nothing. That was Livermore's philosophy. A position must earn its right to grow. A trader's job wasn't to reward potential, it was to reward performance. If the market didn't demonstrate performance early, then every dollar added to the position was a vote of confidence in something that hadn't yet proven worthy. This was the psychological trap Livermore wanted traders to avoid, the trap of imagining potential instead of observing action. To him, the market was a living organism, and its first movements told the truth about its internal condition. A sick stock does not sprint. A tired stock does not leap. A strong stock does not tiptoe. And a truly powerful stock does not wait to reveal itself. This was the root of his protocol. Begin small at the pivotal point. That initial position was not a bet, it was a probe, a test balloon, a diagnostic tool. He didn't enter to make money. He entered to gather information. The size was intentionally small so the trader's psychology stayed neutral, adapted, observant. Then came the waiting, not passive waiting, but active watching for the first thrust. This thrust wasn't simply a price tick upward. It was a behavior. It could be a surge in volume, a clean directional bar, a repeated defense of higher lows, a decisive break with no whiplash, or simply the tone of the tape shifting from uncertain to purposeful. In Livermore's mind, early thrusts carried more weight because they revealed buyer urgency, an urgency that rarely appears by accident. You can fake a breakout. You can fake a news catalyst. You can even fake a chart pattern. But you cannot fake urgency. Urgency comes from accumulation, from large operators committing real capital, from the invisible hands whose fingerprints show up in early moves that are too clean, too sharp, too confident to be random. That is why, when an early thrust appeared, Livermore pyramided not because the price was rising, but because the behavior justified greater exposure. He wasn't adding recklessly. He was upgrading his confidence level based on new evidence. And if the thrust didn't appear, he shrunk, he reduced, he stepped aside. He refused to wait for the market to make up its mind, because markets don't reward patience, they reward alignment. Livermore's danger signal was always time. A stock that hesitated early was like a runner who stumbled out of the starting blocks. Yes, technically it could still win the race, but statistically, behaviorally, psychologically, it rarely did. And that probability edge, the edge hidden inside time, was what he weaponized. To Livermore, time wasn't a dimension, it was a verdict. And he believed that any trade that did not begin working within a reasonable window was a trade whose internal logic was flawed. Maybe the theme wasn't strong enough. Maybe accumulation wasn't present. Maybe the broader market wasn't supportive. Maybe the catalyst was misunderstood. Whatever the reason, he didn't care. His job wasn't to diagnose the cause of weakness. His job was to eliminate it. That is why he said, "Never give a slow trade more time than it deserves." Because more time only enlarged the lie. It didn't fix anything. It only allowed hope to mutate into conviction and conviction into delusion. This is where his maxim, speed of confirmation determines size of commitment, becomes more than a clever phrase. It becomes a mental model for filtering trades. Speed does not mean velocity of price. It means velocity of validation. Livermore believed that every trade carried an internal expectation, an invisible contract. If a stock should move quickly after breakout, then it must move quickly after breakout. If it doesn't, something is wrong. That should was not arbitrary. It was based on decades of observation. He knew how strong stocks behaved. He knew how weak stocks behaved. He knew that strong stocks climbed stairs only after they exploded off the ground. He knew that weak stocks often stumbled sideways before collapsing. By comparing what should happen to what is happening, he derived the clarity that most traders lack. And this comparison, this expectation versus reality framework, is the psychological foundation of the 2/3 time limit. Without expectation, time is meaningless. With expectation, time becomes diagnostic. That is why Chapter 2 sets the stage, not by explaining the rule itself, but by conditioning the trader's mind to think in terms of early confirmation rather than delayed gratification. Livermore's brilliance was not simply noticing early movement. It was noticing what the absence of early movement meant. Most traders interpret silence as neutrality. Livermore interpreted silence as warning. Most traders interpreted sideways drift as compression. Livermore saw it as indecision. Most traders allowed time to soothe their doubts. Livermore allowed time to amplify them. Traders often fall in love with their own scenarios. They imagine a stock creeping upward, breaking out slowly, grinding its way to profit. Livermore knew this was fantasy. The market does not grind upward out of kindness. Trends don't begin as sloths. They begin as athletes bursting off the line. He used to say that the market gives you a preview of its entire move in the first act. The first day, the first hour, sometimes even the first minutes after the pivotal point, reveal everything you need to know. If the stock behaves with clarity early, it will behave with strength later. If it behaves with confusion early, it will deliver trouble later. This wasn't emotional bias. It was statistical inevitability derived from years of tape reading. Livermore internalized a truth that modern traders still resist. Early movement is predictive. Late movement is reactive. The thrust doesn't merely confirm the move. It identifies the move. Everything afterward is follow-through. Everything before is potential. And potential, no matter how pretty it looks on a chart, is worthless without validation. This is why many traders who rely purely on chart patterns fail. They believe price structure is destiny. Livermore believed price behavior is destiny. A pattern is static. Behavior is dynamic. Patterns can lure you. Behavior cannot lie. And behavior always manifests first in the early thrust. When Livermore saw that thrust, he didn't get excited, he relaxed, because now the market was finally agreeing with him. Before the thrust, he was just an observer with a small probing position. After the thrust, he became a participant with growing conviction. This shift from curiosity to involvement was the heartbeat of his entire methodology. But the deeper secret in Chapter 2 is psychological, not mechanical. Livermore knew that humans are terrible at defining quick. To a nervous trader, 5 minutes feels like an hour. To a hopeful trader, 3 days feel like normal consolidation. To a stubborn trader, 3 weeks of sideways drift still feel like building a base. Livermore wanted none of this elasticity. He needed a framework, an objective time window that removed emotional interpretation. And he had it. He used it. And it was astonishingly simple. But he would not reveal it until the trader understood why it mattered. That's why this chapter ends where it does, on the edge of the answer, but not yet inside it. Because before you can learn the 2/3 time limit, you must understand the mindset that powers it. You must understand why time is not a delay, it's a signal. Why the market's opening behavior is not trivial, it's decisive. Why expectation is not imagination, it's a benchmark. and why professionals do not wait for confirmation, they demand it. The mystery of quick remains intentionally unresolved here because the next chapter introduces something far more important than speed. Expectation. The missing link between price and time, the mental model through which Livermore quantified how long a move should take, and what it means when the market violates that expectation. That is the threshold you're about to cross, the moment when time stops being a passive observer and becomes your most ruthless trading filter. Livermore's genius in crafting the two-thirds time limit didn't begin with mathematics. It began with expectation, because expectation is the framework that separates disciplined speculation from emotional gambling. Before he ever calculated a deadline, he forced himself to define what a normal, healthy, powerful move should look like. He believed that if you couldn't articulate what should happen, then you had no business reacting to what did happen. Most traders skip that step. They enter based on patterns, feelings, catalysts, or forecasts, but never stop to define the movement profile. Livermore considered that negligence. If a stock is supposed to run, it should run in a certain tempo. If it's supposed to attract accumulation, that accumulation should express itself inside a predictable rhythm. And if it's supposed to advance decisively, its early performance should reveal that decisiveness. So his first step was simple. He'd ask himself, if this stock is beginning something real, how long will the first two-thirds of its move take? Not the whole move, just the strong phase, the part where the market reveals its conviction. That question became the heartbeat of his method, because it forced him to quantify something most traders leave vague: the time signature of strength. Livermore knew that every market leader, every explosive move, every runaway trend had a tempo. High volatility stocks expressed themselves in rapid bursts. Slow-moving industrials marched with steadier discipline. Momentum names accelerated quickly after pivot points. Defensive names took more time. He would study a stock's previous cycles, observe the length of its impulse waves, and pay attention to how rapidly it typically completed its thrusts. This wasn't guesswork. It was comparative analysis. If a stock normally covered 15% in 6 days during past strong phases, then he expected something similar when it broke out again. Maybe not identical, but comparable. If a stock historically took 12 sessions to make a 30-point leg, then he used that as the baseline. The market wasn't random to him. It was patterned, rhythmic, behavioral. And when behavior deviated sharply from its historical rhythm, he knew that the move was compromised. By setting an expectation calibrated to the stock's personality, he wasn't predicting the future, he was preparing to judge the future. This is the subtle nuance amateurs miss. The two-thirds time limit is not a prediction tool. It's a diagnostic tool. It doesn't tell you where the stock will go, it tells you whether the stock is behaving correctly. Once Livermore had the expectation, the structure became almost mechanical. If the move is supposed to take 9 days, then the first 6 days must deliver two-thirds of the advance. If the move should cover 30 points in 12 sessions, then the first 20 points have to appear in 8. It was clean. It was simple. It was unforgiving. But the reason he used two-thirds wasn't arbitrary. He understood that the first two-thirds of any trend contain the momentum phase, the aggressive accumulation, the point where the insiders, pools, and informed operators exert their influence. That phase is never slow. It never drifts. It never dithers. Smart money does not chase late. It positions early. And because early positioning is aggressive, the early phase of a legitimate move carries force. So if the expected momentum window failed to materialize within the expected clock, he interpreted it as a signal that the underlying energy wasn't there. Time wasn't the enemy, it was the X-ray machine revealing the skeleton inside the trade. He believed that slow progress was not building a base, but exposing a weakness. And this difference, this refusal to romanticize slowness, saved him again and again. The steel stock anecdote captures this perfectly. The breakout looked genuine. The volume suggested accumulation. The tape seemed clean. Livermore entered with a defined thesis: a 20-point advance over 2 weeks. That meant he expected roughly 13 points in the first 10 days. But by day 10, the stock had gained only 3 points. Most traders would have rationalized it. It's consolidating. It's shaking out weak holders. It's forming a shelf. It's preparing for the next leap. Livermore despised rationalization. Rationalization is the mind's way of protecting ego, not capital. He did not care that the breakout looked technically intact. He did not care that nothing bad had happened. He did not care that the stock had not violated any support levels. His rule was absolute. If the stock didn't deliver 2/3 of what it should have delivered in the time it should have delivered it, it failed the test. Not failed. The trade failed the test. That distinction made the difference. His exit was not emotional. It was procedural. Day 10 arrived. The stock was not where it was supposed to be. That was enough. He stepped out. He didn't wait for justification. He didn't wait for confirmation of weakness. He didn't wait for the chart to telegraph collapse. He acted because the time signature was wrong. And 3 days later, when the stock collapsed 12 points, he didn't celebrate being right. Because to him, he wasn't predicting a collapse. He was protecting himself from a stock that wasn't acting according to plan. This is the heart of the 2/3 time limit. It stops you from nurturing trades that are quietly dying. It keeps you from feeding capital into positions that are failing silently. It prevents you from staying loyal to trades that have already signaled their lack of alignment. The rule protects you, not by forecasting the storm, but by recognizing that the absence of sunshine is reason enough to leave. Many traders only react to pain. Livermore reacted to lack of progress. Pain is obvious. Stagnation is subtle. And stagnation is where most accounts bleed out, not in dramatic losses, but in slow, mind-numbing, capital-draining drifts that turn conviction into frustration and frustration into desperation. Livermore knew that the market rarely punishes you with sudden catastrophe. It punishes you by wasting your time until your psychology cracks. The 2/3 time limit was engineered to prevent that erosion. His protocol reflected this brutal clarity. Define the expected move. Define the expected duration, calculate 2/3 of each, then demand the market deliver. If the stock met the benchmark, he grew the position. If it failed, he cut size or exited entirely. There was no "let's wait another day." No, maybe it's just digesting. No, it still looks bullish. For Livermore, the moment a stock violated the time expectation, the trade's internal logic was dead. Not injured, dead. That decisiveness allowed him to shift capital into trades that were behaving properly instead of babysitting ones that weren't. And this reallocation, this constant migration towards strength, was one of the biggest hidden edges of his entire career. Many traders are stuck in weak trades, waiting for them to work, unaware that the opportunity cost is bleeding them far more than the loss itself. Livermore refused to pay that cost. To him, the market was a battlefield, and his capital was cavalry. He would not allow his cavalry to sit idle in the mud while the real battle happened elsewhere. This is why he coined the maxim, "Price tells the story, time tells the truth." A stock can tell a beautiful story with price alone: fake strength, false breakouts, manipulated volume spikes. But time exposes whether that price behavior was genuine or not. Time reveals the depth of accumulation. Time exposes the real conviction behind a move. Time shows whether the smart money is committed or merely pretending. You can trick price. You can disguise volume, but you cannot fake time. Time is the judge, the arbiter, the lie detector. When a stock should move and doesn't, the truth is clear. The underlying force isn't there. Yet this entire chapter sits on a hinge, because everything described so far is structural. The mathematical backbone, the procedural logic, the methodical sequencing. But the real power of the 2/3 time limit isn't mathematical, it's psychological. And that's where most traders break. Because while the rule is simple, living by it is brutally difficult. It requires you to admit that your thesis might be wrong, not because the market reversed, but because the market didn't behave with enough strength. Most people need damage to admit error. Livermore needed only disappointment. This is alien to amateurs. They cling to trades that are merely quiet, assuming quiet is harmless. They confuse lack of movement with safety. They assume the absence of pain means the presence of support, and they violate the 2/3 time limit because emotionally, it feels premature to exit when the stock hasn't done anything wrong. But that is the trap. Trades almost never signal their wrongness in obvious ways. They reveal it subtly, quietly, through lethargy. Livermore built a rule that forces you to act before the market forces you to feel pain. Chapter 3 intentionally ends on the surface, on structure, because the deeper layer, the psychological layer, is what transforms this rule from a technique into a worldview. It's the part that explains why most traders sabotage themselves when applying the rule, why they reinterpret slowness as strength, why they invent narratives to justify staying, and why professionals treat time as the ultimate arbiter of alignment. The next chapter pulls you into that psychology, the layer amateurs misunderstand, the layer professionals live by, and the layer that determines whether this rule will become a superstition or a weapon in your hands. Most traders believe fear and greed are reactions to price movement, spikes, drops, volatility, breakouts. But Livermore discovered a sharper, more uncomfortable truth. The real emotional damage comes not from movement, but from the absence of movement. Time spent inside uncertainty is what corrodes the mind. A fast loss is clean. A fast win is energizing. But a slow trade, one that drifts, stalls, hesitates, becomes a psychological vacuum. And in that vacuum, your worst impulses multiply. That's why Livermore wrote that a slow market is the most dangerous partner a man can keep, because it seduces him into maintaining positions that no longer deserve his capital or his attention. And here's the counterintuitive reality most traders never understand. A slow trade is more dangerous than a losing trade. A losing trade is contained. The stop loss cuts the wound, defines the damage, and allows the trader to reset. A slow trade bleeds quietly, invisibly, not through price but through the internal erosion of judgment. Every additional hour spent in a lagging position weakens the psychological muscles required for disciplined execution. The mind begins to rationalize. It still looks fine. It's consolidating. It just needs more volume. I can give it another day to prove itself. That rationalization is not logic. That I can still me. The starts it betters. That I still, the problement. It is the brain trying to protect the ego that placed the trade. Livermore treated this erosion as the real enemy. He would often say that amateurs think the enemy is the market, but the enemy is actually the mirror. And nothing triggers the mirror more than dead time. The absence of progress forces you to confront your own doubts. It makes you chase opinions. It makes you adjust stops to give it more room. It makes you lower your standards while telling yourself you're being patient. Patience is a virtue only when it is intentional. Otherwise, it becomes disguised passivity. Professionals treat waiting as a position. Waiting is strategic. Waiting is precise. Waiting is the act of conserving psychological capital until the market shows alignment. But amateurs wait out of hope. They wait because doing nothing feels like failure. They wait because closing a lagging trade forces emotional accountability. Hope is free, but the loss that follows it never is. This is why Livermore built the 2/3 time limit as a shield, not a prediction tool. It prevented him from entering the emotional fog where rational judgment collapses. The anecdote of his protege illustrates this danger vividly. The young trader entered a mining stock, expecting a 10-point move in 7 sessions, a perfectly structured thesis. But by session 5, the stock had advanced only 1 point. The protege tried to defend the position by saying, "It still looks good." That sentence is the anthem of amateur trading. Livermore cut through it with a single line. It looks undecided. The market decides quicker than that. To him, a stock that refuses to progress is a stock voting against your thesis. Price may appear stable. Volume may appear normal. The chart may not be breaking down. But indecision itself is a verdict. A stock that refuses to move is sending the same message as a stock moving against you. Your read is not aligned with the market's intent. The protege ignored the principle. He waited. He defended. He rationalized. And as the stock drifted for another week, he found himself trapped deeper emotionally, not technically. When the drop finally came, it cut past his stop, creating a loss that could have been avoided entirely. His pain didn't come from misreading the trade. It came from letting time blur his objectivity. Livermore designed the two-thirds time limit to prevent precisely that spiral. The protocol that protected Livermore is simple, but psychologically punishing. If the market confirms early, lean in. If it delays, back off. If it lags past the two-thirds time limit, get out without negotiation. The rule is indifferent to your conviction. It doesn't care about your research. It doesn't care about your opinions. It doesn't care about how close the trade feels to proving itself. The rule cares about progress, real, measurable, time-bound progress. And once that window closes, the professional exits, because he understands a deeper maxim: uncertainty compounds faster than capital. Uncertainty breeds doubt. Doubt breeds hesitation. Hesitation breeds error. And error breeds losses larger than any chart pattern can warn you about. Amateurs believe uncertainty is something they can endure. Professionals know uncertainty is something that must be managed with structure. Without a time-based exit, the trader's mind becomes the playground of fear, stubbornness, and rationalization. There is a reason Livermore emphasized that the psychological cost of a slow trade is always greater than the financial cost. A slow trade ties up mental bandwidth. It drains creative energy. It narrows focus until you see only the trade you're trapped in, rather than the opportunities emerging everywhere else. It becomes a gravitational sinkhole for your attention. Livermore knew that attention is a form of capital. A trader who spends his attention on dead trades becomes blind to the setups that actually deserve his money. The two-thirds time limit was his antidote to that blindness. By enforcing a deadline, he freed his attention to scan for strength instead of babysitting weakness. And this constant reallocation from laggards to leaders was a hidden engine behind his greatest advances. Traders who hold slow trades miss fast ones. Traders who cling to indecision lose their edge to those who demand alignment. Livermore believed that the market reveals its character early, not late, and he believed that traders reveal their discipline not in their losses, but in their willingness to abandon stagnation. Cutting a loser is easy when the chart is red and falling. Cutting a slow mover is difficult because it lacks the emotional trigger. There is no urgency, no panic, no shock, just drift. And drift is where hope survives. But hope is not part of a professional system. Hope is the default state of an unstructured trader. This chapter, however, is not complete until we address the deeper emotional mechanic behind why amateurs violate the two-thirds time limit. The rule requires humility. Thanks for watching. To subscribe to Deo Live. It requires the acceptance that the trader cannot force outcomes, cannot accelerate the market, cannot will a stock into momentum. Amateurs secretly believe they can influence the market by waiting. They believe that giving a dead trade more time is an act of maturity, when in reality it is an act of avoidance. The two-thirds time limit forces you to admit that the market, not your thesis, sets the tempo. It forces you to acknowledge that the stock owes you nothing. It forces you to recognize that time is a verdict, not a neutral backdrop. Time either confirms your thesis or contradicts it. And when time contradicts it, staying in the trade is not patience, it is ego preservation. Many traders misunderstand the rule because they think it is rigid, but Livermore built it to create internal flexibility. When you exit a lagging trade, you free capital. When you free capital, you free optionality. When you free optionality, you regain psychological clarity. This cycle clarity optionality opportunity is impossible when you're shackled to a trade that refuses to move. The two-thirds time limit is not a cage, it is a release valve. And yet, this still does not close the opening loop of the entire script, because understanding the rule is one thing, but applying it precisely, consistently, unemotionally, is another. Traders often ask, how do I apply this rule in real time? How do I estimate expected duration? How do I measure 2/3 of the move? What if the market environment is changing? How do I adapt this to modern volatility? The final chapter brings everything together. It applies the rules step by step, shows you the practical workflow Livermore used, and reveals the final example where he transformed a slow setup into a fast win simply by respecting time over price. Now we close the loop. This is the moment where structure meets habit and method becomes practice. At the start, we said winning trades prove themselves early. And that early proof is the clearest signal you can trust, because it precedes the crowd. When a trade shows its character quickly, you can allocate capital with conviction rather than conviction with capital. The 2/3 time limit is how Livermore enforced that truth. It is a simple, behavioral filter that enforces discipline and prevents emotional leakage. Think of it as a deadline for validation rather than a prophecy of profit. Here's how to apply it today, step by step. I will walk you through a concrete workflow you can use on every pivot and breakout. Treat each step as a test the market must pass before you escalate your commitment. Define your expected move. Estimate a realistic target based on the chart, the recent range, and the sector dynamic. Avoid wishful thinking. Use data and comparable runs to frame the available upside. If you're trading a breakout, identify its typical range. Breakouts vary, some are explosive, others require confirmation. Know which one you face. Measure the prior base or the price pattern to calculate a reasonable expected range. Use volatility, past behavior, or measured moves. Volatility tells you how fast price normally travels in that security, so it should shape your clock. Higher volatility means shorter clocks. Lower volatility demands patience but still needs validation. Define expected duration. Translate your expected move into a temporal window before the trade begins. This duration is your benchmark for judgment, not a wish to be negotiated with the market. How long does this stock usually take to complete that type of move? Trends have clocks. Every trend moves at a certain cadence. Matching that cadence is how you avoid premature scaling. Treat them with respect. Respecting that clock means you stop romanticizing sluggish action and start rewarding real acceleration. Calculate 2/3 of each. 2/3 is not mystical, it aligns with the momentum phase where true conviction shows. By testing for 2/3 completion, you capture the part of the move driven by informed buyers. 2/3 of the move. If your expected move is 15% in the entire run, expect roughly 10% to arrive early as a sign of life. If that early chunk fails to appear, the rest of the trajectory is less probable than you think, 2/3 of the time. If you estimate 9 sessions for the move, then 6 sessions is your decision window. A market that cannot deliver 2/3 of the move in 2/3 of the time is telling you it lacks momentum. Track progress. Monitor both price and the tape. Volume profiles, bid-ask tone, and intraday thrusts matter. Keep notes. Compare actual progress to your expected progress at the checkpoint you defined before entry. If the market reaches 2/3 of the move within 2/3 of the time, when the market honors your expectation, you have statistically more probability on your side. This is the moment to incrementally increase size, tighten your mental model, and let profits compound. You pyramid. Pyramiding is not aggression. It is rational scaling, triggered by evidence of alignment. Add in measured pieces, each backed by the market's continued demonstration of intent. You increase size. Increase only if the tape supports the move and the broader market environment remains constructive. Size should always be a function of confirmation, never wishful thinking. You trust the trend. Trust here is operational. It means you act according to rules, not stories. You still manage risk, but your psychological load decreases because new evidence supports action. If it fails, failure to meet the 2/3 test is not tragedy, it's information. Treat it as a signal to reduce exposure and reallocate attention to higher probability opportunities. Cut size. Reducing size preserves capital and psychological bandwidth. It's often more valuable than minimal extra profit. Cutting is an act of discipline, not surrender. Tighten stops. Tightening stops protects you from slow decay into larger losses while the trade lingers. Adjust stops to the new reality. Do not leave them as relics of your original, now invalid, thesis. Exit if stagnation continues. Be willing to exit. Exiting a lagging trade is a performance-preserving action. Remember, opportunity cost often exceeds the paper loss you avert by exiting early. Never negotiate with the clock. Arguments about maybe it will pick up are the mind's attempts to avoid accountability. Your rule book must be stronger than your imagination. Hope is not a trading plan. Hope lacks measurement. Plans have checkpoints. Replace hope with a time-bound checklist before you ever commit capital. The final anecdote crystallizes the point. Livermore once exited a sluggish railroad stock after it failed his time test. The railroad had the right look but lacked the right tempo, so he rotated the capital into a strong leader breaking out of a multi-month base. That second trade hit its 2/3 milestone in 3 days, and the redeployment produced outsized, compounding gains relative to the stagnation he avoided. He didn't wait for the decline to validate his exit. He exited because the time test failed, and then redeployed. He often said, "Capital moves to where it's respected." Capital moved quickly to a leader that was signaling clear intent, and that redeployment produced compounding gains. This maneuver exemplifies the tactical advantage of using time as a filter. The rapid 2/3 milestone on the second trade is evidence the market had shifted in favor of his redeployment. He did not celebrate on the first trade's failure. He acknowledged the system worked and moved on. Maxims to remember are your anchors when the market tempts you to overstay. Price tells the story. Time tells the truth. Price provides the narrative. Time verifies whether that narrative is supported by force. Use both, but privilege time when they disagree. Speed of confirmation determines size of commitment. Speed is your signal for scaling and for allocating mindshare from one trade to the next. Fast confirmation reduces mental friction and increases compounded effectiveness. Uncertainty compounds faster than capital. Left unmanaged, uncertainty multiplies mistakes far beyond the initial capital at risk. The rule's primary value is psychological preservation as much as it is financial preservation. Actionable recap is your checklist. Cut losses fast. Quick realized losses limit emotional residue and allow you to redeploy funds where edge exists. Size small until confirmed. Small initial size reduces the psychological cost of being wrong and keeps options open. Think of the first piece as a signal purchase, not a stake in an outcome. Wait with intention. Active waiting requires metrics, time windows, expected moves, and tape checks. It's the opposite of passive hope. It's controlled engagement with a stopgap for action. Let time filter the truth. Time will either bless your thesis or deny it. Let it be the tiebreaker in ambiguous situations. If time denies you, take it as privileged information to redeploy capital elsewhere. Respect the 2/3 deadline. Treat the deadline like a contractual obligation you made with yourself as a steward of capital. Breaking that contract erodes discipline and compounds into larger mistakes. Consider a biotech breakout where binaries dominate. Your time expectations must account for trial timelines and news risk. Otherwise, the 2/3 test will be misapplied. Consider a commodity name influenced by inventory reports. Its rhythm may stretch and require longer clocks, but still needs to meet a reasonable 2/3 benchmark relative to its typical cycles. Practice estimating expected durations on historical runs and record the accuracy. Your calibration will improve faster than your intuition if you treat this like an experiment. When you journal these decisions, include the expected move, the expected duration, the 2/3 checkpoints, and the result. Over time, the data will reveal which settings work for different instruments. If you trade across multiple timeframes, apply the 2/3 concept at each timeframe to avoid conflicting signals that arise when a daily chart looks sluggish but an intraday setup is clean. Use the rule as a filter before you add size, not as an afterthought to justify existing. Exposure. This inversion protects you more than any stop-loss ritual. If you are tempted to wait one more day, Consider the opportunity cost. What leader are you ignoring while you guard a laggard? Adopt the mindset that every exit funded by the two-thirds rule is an act of capital preservation and strategic redeployment, not an admission of error. Finally, remember that this framework is scalable. It applies to single stock trades, sector rotations, and even portfolio-level allocations. The principle remains the same. Combine precise entry location with a time-bound expectation, and you have an operational advantage few traders maintain. This combination transforms random outcomes into process-driven probability management. You will start to see how many trades you previously held were merely time sinks, not opportunities. Your portfolio will become more nimble, your psychology sturdier, and your capital more productive. If this sank in, your next step is simple. Study the video on pivotal points, because combining pivotal points with the two-thirds time limit will transform your trade selection forever. Pivotal points give you superior entries. The two-thirds time limit gives you superior exits. Practice this rule relentlessly until reaction yields disciplined gains.